Today we're going to extract 4 key lessons from the book that made Warren Buffett billions of dollars. Hello fellow compounders. Welcome to Always Be Compounding, the channel that helps you build wealth. I'm Dennis Chen, a full-time investor and author of The Option Trader's Hedge Fund, a book published by Financial Times Press. I have an MBA from the Wharton School of Business. I'm a CFA charter holder, a former management consultant at Bain & Company, former hedge fund manager, and entrepreneur. As I said, today we're going to learn 4 key lessons from the book that made Warren Buffett a billionaire. Let me quote Warren Buffett from his 2013 letter to investors. Quote, "Before reading Ben's book, I had wandered around the investment landscape, devouring everything written on the subject. Much of what I read fascinated me. I tried my hand at charting and at using market indicators to predict stock movement. I sat in brokerage offices watching the tape roll by and listened to commentators. All this was fun, but I couldn't shake the feeling that I wasn't getting anywhere." Warren Buffett read this book, The Intelligent Investor, at the age of 19, and it changed his life. This book introduced Warren to an investment framework which he didn't have. Based on that framework, he went on to build the Buffett partnerships, and eventually he bought Berkshire Hathaway, and the rest is history. Berkshire Hathaway is currently one of the top 10 most valuable businesses in the United States. And Warren Buffett has a net worth of over $100 billion, as I mentioned in one of my previous videos. So let's get down to it. What are the key 4 lessons that we can extract from this book? Actually, there's many lessons in here, but I'll just focus on 4. First lesson, what's the difference between an investor and a speculator? Let me quote Ben Graham from chapter number 1 of the book. "An investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return. Operations not meeting these requirements are speculative." From that we gather that investors look at the fundamental value of the stock, independent of the price. In fact, in the book, Graham says that investors should not worry about the fluctuations in price of a stock. In a speculators tend to just look at price. They don't really care what the intrinsic value of a stock is, or when I say stock, of a business is. They just care about the price. They're buying something hoping that somebody else would pay a larger price for it. Let's take an example. Let's take a piece of gold and an acre of farmland. So if you were an investor, you would analyze both options. Piece of gold generates nothing. Basically, you can sell it to somebody else, and you have to depend that the other person is willing to pay you more than what you paid for it. The piece of farmland can actually produce something. You could plant corn or wheat or whatever, apples, I don't know. You could plant something and generate some value out of it. You don't depend on somebody else having to pay you more for that piece of land. So that has some type of intrinsic value that can generate and produce something. So in this case, gold will be speculative because you really depend on the greater fool's theory that somebody else, another fool, will come and buy it from you at a greater price. And the farmland, even though nobody came and bought it from you, you could produce something out of it. So that's the difference between investing versus speculation. Point number 2, the other thing that we learned from The Intelligent Investor is that a stock is a piece of ownership of a business. You're actually buying a piece of a business. So when you're analyzing stocks, you're not looking at price, you're looking at value. You're looking at what is that business worth? What is the underlying business producing? So if you had a stock of Coca-Cola, what is the business producing? It's producing sugar water that makes people happy. And it has a recurring revenue stream because people drink Coke, they feel happy, next day they go again and again and again and again. So that is what we learned. Think of a stock as ownership in a business. And that's the framework that Warren Buffett used when he's analyzing his stocks, his investments. He's looking at these businesses. For example, Warren Buffett, Berkshire Hathaway owns 5% or more right now of Apple. But when he looks at it, he looks at Apple, the business. He doesn't look at the piece of paper that says, 5% of Apple. He's saying, I own Apple. Apple that produces iPhones and Macs and other stuff. It's a consumer product type of business. So in his Berkshire Hathaway letters, he thinks of his participation in Apple as the fourth business or the fourth major business that he has in the entire portfolio of Berkshire Hathaway. Berkshire Hathaway right now has a market cap of around $700 billion, out of which Apple is worth, I think, 150 to 180 billion, somewhere around there. It's a significant chunk. The third concept that Warren Buffett learned from The Intelligent Investor. Ben Graham came up with this allegory of this character called Mr. Market. It's a way to refer to how the market behaves. And in this book, he says, look, think of Mr. Market as your partner. Let's say you have a business in which you have participation with Mr. Market. So you own a stock worth $1,000 in a business with Mr. Market. Mr. Market is a manic depressive type of guy. Every day he would come and offer you a price. When he feels happy and very positive, he will offer you prices that are very, very high. So if he's feeling in a good mood, he'll probably offer you, I don't know, $1,500, $2,000, $3,000 for your stock. I mean, you can either, and the rule is that you can either sell to him or buy from him at the price that he quotes. And when he's feeling really depressed, he will offer you his share at depressed prices. He'll offer you his share at $800, $500, $100, depending on how he's feeling that day. So the market is like that. Mr. Market is all over the place, and you just have to decide whether you sell to him or buy from him. But in order to do that, so basically that's Mr. Market, a manic depressive fellow that comes around every day and quotes your price for your business, for your participation in the business. And all you have to do is know exactly, know how much is the intrinsic value, what's the value of your share worth, and in this case, that's $1,000, and take advantage of Mr. Market. When he's feeling depressed, you can buy from him, or when he's feeling really happy, you can sell to him. And don't let Mr. Market determine how you manage your business. You manage your business and let Mr. Market serve you. That's exactly what Buffett does. He goes out and waits for when Mr. Market is depressed, values are depressed, he goes out and buys from him. And when things are, and basically that's the magic formula that Warren Buffett does. The fourth concept that we get from this book is the concept of margin of safety. Margin of safety is really a concept that Ben Graham probably borrowed from engineering. The analogy is, let's say that you have a bridge that can take 10,000 pounds of load, and you're driving a truck that weighs 9,900 pounds, and you're going over, you're crossing a river that has a precipice of 10,000 or 1,000 feet. Well, would you feel comfortable crossing that bridge, knowing that you have a very slight difference between the load and how much your truck weighs? I don't know, maybe somebody ate too much that day and you're actually overweight, and who knows. So margin of safety says something like, well, maybe you should look for a bridge that can take 20,000 pounds so you can cross your 9,950 pound truck. It's the same thing applies to investment. When Warren Buffett or whoever, or the intelligent investor goes out to buy an investment, to buy a business, you value the business, and you understand, and you estimate the value. of the business. Then you discount a certain amount of price to give you a margin of safety. So let's say you're buying a business or a stock in a business that you think is valued at $100 per stock. And so you would give you a margin of error, let's say 50%. So you'll be comfortable buying that stock at $50 because you think, well, maybe I might have had a mistake in my calculations. Maybe this is my value is so much, but, or maybe it's something where I'm not that comfortable with. I really hope I need to give it a wider margin of safety. So let's say 50%. So if the stock, now you go to the market and ask Mr. Market, how much is this stock? What's the price of this stock, which you believe it's worth $100? And Mr. Market comes back and says, oh, I'm selling it for 40. In that case, of course you'll buy it. You have a wide margin of safety, and it'll give you space for upside. On the other hand, Mr. Market says, oh, it's pricing at $110. Obviously you won't. Even if it's pricing at $95, maybe you won't, because it's too close to your valuation. It's not worth it. Keep on looking. That's it. These are the 4 key concepts that I think Warren Buffett appreciated from the book. The 4 key lessons that we learned from this book are: 1, understand when you're speculating or investing. 2, remember that a stock is a participation in a business. It's a part ownership of a business. So think about the business, evaluate the business. 3, understand that Mr. Market is very manic depressive. So it's very moody. So that means the cycles in the market will go up and down, and you really don't have much control of it. Your control is when you buy and when you sell, but don't let Mr. Market influence your behavior. And 4th is really the concept of margin of safety. That's a very key and important concept. So important that Seth Klarman, which is another disciple of Ben Graham, wrote a book called Margin of Safety. I highly recommend it. So thank you very much. That's it for now. Look forward to seeing you in future videos, and we'll keep learning about how to build wealth and learning from our fellow compounders like Warren Buffett, Seth Klarman, and others. Thank you very much. So long. Take care.